In 1995, Sarah and John bought two houses side by side in Seattle, $150,000 each. Same neighborhood, same year, same price. They were the kind of neighbors who waved from the driveway, who watched each other's kids grow up. Both worked hard their whole lives. Both paid off their mortgages. Fast forward to last year. John started worrying about nursing home costs. He'd heard stories, people spending down everything they had, the government coming after the house after they were gone. So he did what felt logical. He walked into a county office, paid $25 for a quitclaim deed, and signed the house over to his son. Clean, done. He went home, feeling like he'd just protected his family. Sarah did nothing like that. She just updated her will, kept the house in her name, and trusted that things would sort themselves out when the time came. Both of them passed away this year. The house, both houses, same street, were now worth $650,000. Sarah's daughter inherited and sold. Tax bill from the IRS $0. John's son inherited and sold. Tax bill from the IRS $75,000. Same street, same house value, 30 years of the same life. One signature made a $75,000 difference. And here's the thing that keeps me up at night about this. John wasn't being careless. He was being protective. He was trying to take care of his kid. He just didn't know that the move he made to protect the house from Medicaid permanently destroyed a tax benefit his son would have otherwise received automatically. For free, just by waiting. Why does that happen? What exactly did John give up when he signed that paper? And what should he have done instead? That's what we're going to break down. Because this mistake isn't rare. It's happening in counties across the country right now, one $25 form at a time. Let's start with the number that explains everything, $150,000. That's what John paid for his house in 1995. In tax language, that's his cost basis, the starting point the IRS uses to calculate how much profit he made when the house eventually sells. Now here's where the system gets interesting. When John gave that house to his son while he was still alive, something happened to that $150,000 number. It transferred. His son didn't get a fresh start. He got John's original purchase price. So when the house sold for $650,000, the IRS looked at his son and said, "Your gain is $500,000. That's $650,000 minus $150,000. And at a 15% long-term capital gains rate, that's $75,000 owed. That's the whole bill. That's where the number comes from." Now let's look at what happened to Sarah's daughter. Sarah kept the house in her name until she passed. Under IRS Section 1014, when someone inherits property, the cost basis automatically resets to whatever the property is worth on the date of death. So the daughter's basis wasn't $150,000. It was $650,000. She sold at $650,000. Gain $0. Tax $0. Same house, same sale price. Two completely different tax outcomes because of when and how the transfer happened. This is what's called the step-up in basis. And it's not a loophole or a trick. It's a built-in feature of the tax code that every inherited property qualifies for automatically. You don't have to apply for it. You don't have to ask. You just have to not give the house away before you die. I've been close to enough of these situations to say this plainly. When people find out they lost it, the reaction isn't anger. It's a kind of quiet devastation. Because the paperwork seemed so simple. I'll be honest, when I first started working in this space, I thought giving an asset away meant you were done with it. Clean transfer, no complications. It wasn't until I sat across from a family who had to sell their mother's house, The one she'd lived in for 35 years, just to pay the capital gains tax that I understood what carryover basis actually costs in real life. Not as a concept, as a number on a check. You didn't do anything wrong. Wanting to protect what you built, that instinct is completely right. The problem isn't the intention. It's that the tax code doesn't work the way our instincts tell us it should. Giving feels like protecting. But to the IRS, a gift is a taxable event waiting to happen. So why do people do it anyway? Because of a word that cuts through every rational financial calculation, Medicaid. The fear isn't abstract. $115,000 a year for a private nursing home room. A spouse left behind with almost nothing. The government coming after the house after you're gone to recover what they paid out. That fear is real, and it's well-founded. But here's the part that matters. The quitclaim deed that people use to protect the house from Medicaid. It doesn't actually do what they think it does. And the step-up in basis they throw away in the process? That's gone permanently. That's the trap. Not a scam. Not bad advice from someone trying to hurt you. Just a $25 fix for a $75,000 problem. The fear of nursing home costs isn't new, but the numbers behind it have gotten harder to ignore. According to Genworth's most recent cost of care data, a private room in a U.S. nursing facility now runs over $115,000 a year on average. That's not a coastal outlier. That's national figure, and it's been climbing steadily for years. Think about what that means in practice. If you or your spouse needs skilled nursing care for 2 years, which is not an unusual stay, you're looking at $230,000 out of pocket before Medicaid even enters the picture. If the stay runs longer, the math gets harder fast, and the odds of needing that care are higher than most people want to admit. The Social Security Administration puts it plainly. A 65-year-old today has roughly a 70% chance of needing some form of long-term care before they die. That's not a worst-case scenario. That's the baseline probability for someone who is otherwise healthy and expects to live into their mid-80s. So the fear that drives people toward quitclaim deeds, that fear has a legitimate foundation. This isn't paranoia. It's a reasonable response to a real financial exposure. What changed the stakes permanently was a piece of federal legislation most people have never heard of, the Medicaid Estate Recovery Act of 1993. Before that law, Medicaid paid for nursing home care. The person passed away, and that was largely the end of it. After 1993, states were required to pursue recovery, meaning the government could come back after death and file a claim against the estate to recoup what Medicaid had spent. For most people, the estate is the house, which means the house they spent 30 years paying off suddenly had a creditor attached to it that they never signed up for. I've watched that realization land on people in their late 50s and early 60s, usually during a conversation about something else entirely. They didn't know the rule existed. Nobody told them. And by the time they found out, they were already trying to work backward from a position of panic. That panic, the fear of losing the house to Medicaid recovery, is what pushes people toward the quitclaim deed. It feels like the only lever they can pull. Fast, cheap, final. But the very fear that's supposed to protect them ends up driving them into a worse outcome, because a panic transfer doesn't beat Medicaid. It just trades one problem for two. So let's talk about what the quitclaim deed actually does and doesn't do. A quitclaim deed is a document that transfers your ownership of a property to someone else. It costs about $25 in filing fees. It takes an afternoon. And it feels decisive, like you've drawn a clear line between your assets and whatever Medicaid might come looking for later. The problem is Medicaid already thought of this. There's a rule called the 5-year look-back period. When you apply for Medicaid to cover nursing home costs, the program reviews every asset transfer you've made in the past 5 years. If you gave away your house or anything of significant value during that window, Medicaid treats it as an improper transfer. They calculate how long that asset would have covered your care, and they make you wait that long before your benefits kick in. No reimbursement, no exception. Just a penalty period where you're expected to cover the costs yourself with money you no longer have. So, the $25 deed that was supposed to protect you from Medicaid can actually lock you out of Medicaid at the exact moment you need it most. That's consequence 1. Consequence 2 is the one we've already been through. The moment you sign that house over to your kids, the step up in basis is gone. Your $150,000 purchase price becomes their starting point. And when they sell a house worth $650,000, they're staring at a $75,000 tax bill that would have been $0 if they'd simply inherited it. You lose the Medicaid protection you were trying to get, and you hand your kids a tax liability they didn't ask for. 1 signature, 2 consequences, neither of them visible on the day you signed. I remember a client, King County, Washington, who came in with a quitclaim deed they'd already filed. They set it on my desk with the $25 receipt still paper clipped to the front, proud of it. They'd handled it themselves, saved the attorney's fees, and felt like they'd checked the box. What they didn't know was that they'd just erased 30 years of appreciation from their kids' tax basis, and if they needed a nursing home within the next 5 years, they'd be on their own for the bill. That's the moment I started understanding why cheap solutions to complex problems cost more than the expensive ones. So what actually works? There are 2 structures worth knowing. They're not interchangeable, and the right one depends on your situation, but understanding the difference is where this gets useful. The first is a Revocable Living Trust. This is the most common estate planning tool for a reason. Your assets sit inside the trust, you maintain full control during your lifetime, and when you pass, everything transfers to your beneficiaries without going through probate court. Your kids get the step up in basis. The whole process stays private and moves quickly. What it doesn't do, protect you from Medicaid. Because you still control the assets, Medicaid still counts them. A revocable living trust solves the probate problem and preserves the tax benefit. It doesn't solve the nursing home cost problem. The second structure is a Medicaid Asset Protection Trust, usually called a MAPT. This one is different in a critical way. It's irrevocable, meaning once assets go in, you give up direct control. That's the trade-off that makes it work. Because you no longer control the assets, Medicaid generally can't count them after the 5-year look-back period clears. But here's what makes the MAPT genuinely powerful. When structured correctly as a grantor trust, it still qualifies for the step-up in basis under IRS Section 1014. Your kids inherit the property at the current market value, not your original purchase price. The tax benefit is preserved. The Medicaid protection is in place. And you didn't have to sign anything over to your kids directly. It's not a loophole. It's a structure that was specifically designed to address both problems at once. The cost to set one up properly runs somewhere between $3,000 and $5,000 in attorney's fees, depending on complexity and where you live. That sounds like a lot until you put it next to $75,000 in capital gains tax and a potential penalty period that leaves you unprotected when you need coverage most. The $25 quitclaim deed feels like the smart, scrappy move. The $4,000 trust feels like overkill, but one of them actually solves the problem, and it's not the cheap one. Beyond the taxes and Medicaid, there's one more risk that doesn't get enough attention, and it has nothing to do with the government. It has to do with your kids' lives. When you sign your house over to your kids, you're not just making a tax decision. You're making a bet on their future, and that bet is riskier than most parents want to think about. Here's the scenario nobody walks through when they're standing at the county recorder's office with a $25 deed in hand. Your son or daughter now legally owns your house. Their name is on the title, which means your house is now subject to whatever happens in their life. Start with divorce. The divorce rate for Americans in their 30s and 40s, the age group most likely to be receiving a property transfer from their parents right now, remains high enough that it's not a remote possibility. It's a planning assumption. And in most states, if your child owns a property when they go through a divorce, that property is on the table. It doesn't matter that it used to be yours. It doesn't matter that you still live there. Once your name came off the deed, your protection went with it. I've watched this play out, not as a hypothetical. A parent transfers the house to keep it away from Medicaid. The adult child goes through a difficult divorce 2 years later. The house, the parent's house, the one they've lived in for decades, becomes a line item in a settlement negotiation. The parent is still living there. They have no legal standing to stop it. That's not the government taking the house. That's a situation the parent created by trying to protect themselves. Now consider debt. If your child gets sued, a serious car accident, a failed business, a personal liability judgment, creditors can go after assets in their name. Your house qualifies. A lien can be placed on it. In a worst-case scenario, it can be forced into sale to satisfy the judgment. Again, it doesn't matter that you live there. Legally, it's theirs. These aren't edge cases. They're the normal range of things that happen to people in their 30s and 40s over the course of a decade. The irony is almost painful. You transferred the house to protect it from an uncertain future risk. In doing so, you exposed it to the very real, very present risks of your child's current life. Risks that have nothing to do with nursing homes or estate taxes. A properly structured trust eliminates this entirely. The house doesn't sit in your child's name. It sits in the trust. Your child may be the beneficiary, but they don't own it outright, which means their creditors can't reach it, their divorcing spouse can't claim it, and their financial misfortunes can't touch it. You maintain the control. The asset stays protected on both ends. That's not about distrust. Most parents who set this up have complete faith in their kids. It's about the fact that life is unpredictable, and a well-built structure doesn't depend on everything going right. I want to take a step back from the numbers for a moment. Because if you've been watching this video and feeling a low-grade anxiety in your chest, I want to name what that actually is. You spent decades paying off that house. You remember the first mortgage payment. You remember the years where it was tight, where the house payment was the number you built everything else around. And now you're at a point in life where you can see the finish line, and the idea that something, a nursing home, a government recovery program, a tax bill, could undo all of that feels genuinely unbearable. That's not irrational. That's not a cognitive bias. That's a completely understandable response to a real threat. The impulse to act immediately, to sign something, to move the asset, to draw a line, that instinct comes from the same place that got you this far. You're a problem solver. You see a risk, you move to contain it. That served you well. The trouble is that this particular problem responds very badly to fast, cheap solutions. The quitclaim deed feels decisive. It feels like action. but it's the financial equivalent of patching a structural crack with paint. It looks resolved from the outside. The problem underneath keeps growing, and there's something else at work too. Most people who go the quitclaim route don't do it because they're uninformed. They do it because getting the right answer feels complicated and expensive, and like something that requires a level of financial sophistication they're not sure they have. So they find the version that feels manageable. $25 one afternoon, done. I understand that completely. I'm not a lawyer, and I don't know every detail of your situation. But I do know what the IRS numbers say, and those numbers don't adjust for good intentions. The shift that actually helps isn't about finding more information. It's about reframing what you're trying to build. Not how do I move this asset out of reach, but how do I build a structure that protects both me and my kids without trading one problem for two. That shift from transaction to structure is what separates a $25 mistake from a $4,000 solution that actually holds. You've spent 30 years building something real. The last decision you make about it deserves more than an afternoon at the county recorder's office. So where do you actually start? Not with a lawyer. Not yet. Start with a number. Pull out your original purchase documents, the HUD-1 settlement statement, the closing disclosure, whatever you signed at the title company when you bought the house. That document has your original purchase price on it. That's your cost basis starting point. If you've done significant work on the house since then, a new roof, a kitchen remodel, an addition, those costs can be added to your basis. The IRS calls these capital improvements, and they reduce your taxable gain when the house eventually sells. So if you paid $150,000 for the house and put $40,000 into it over the years, your adjusted basis is $190,000, not $150,000. That matters. Once you have that number, get a current market valuation. A formal appraisal, a recent comparable sale analysis from a local agent, or a county assessment. Something that gives you a defensible current value. The gap between those two numbers is your potential taxable gain. That's the exposure you're working with. For a lot of people watching this, that gap is significant. And seeing it clearly, as an actual dollar figure, not an abstract concern, is usually what moves the conversation from, I should probably deal with this someday, to I need to deal with this now. From there, the next step is a conversation with an estate planning attorney, not a general practice attorney, someone who specifically works in estate planning and has experience with Medicaid planning in your state. Medicaid rules vary by state. The look-back period is federal, but the recovery rules and exemptions have state-level variations that matter. When you sit down with them, ask specifically about the Medicaid Asset Protection Trust, not Irrevocable Living Trust. Those are useful tools, but they don't solve the Medicaid problem. Ask about the MAPT. Ask how it interacts with the step-up in basis in your state. Ask what the 5-year clock looks like given your current age and health situation. The cost to set this up properly, $3,000 to $5,000 in most cases, is real money. But put it next to the number you just calculated. If your potential capital gains tax exposure is $75,000, the attorney's fee is the cheapest line item in this entire conversation. And if you're not ready to make that call yet, if you're still in the thinking it through stage, start with one thing. If you're currently planning to add your child's name to the deed, or you've already started that process, pause it. That's the one action that permanently closes the door on the step-up in basis. Everything else can be figured out. That one can't be undone. If you're at that point right now, if you're considering adding a name to the title, comment stop below. I'll send you a checklist of the questions you need to ask an estate planning attorney before you sign anything. No cost. Just the questions that will tell you whether what you're about to do is actually protecting your family or creating a problem that costs them $75,000 to clean up. Let's come back to John. He signed that paper because he loved his son, because he'd spent 30 years paying off that house, and the idea of losing it to a nursing home felt like losing everything he'd worked for. The $25 deed felt like the one thing he could do right now that would draw a line. I don't think John made a foolish decision. I think he made a scared one. And scared decisions, made without the right structure behind them, have a way of costing the people we love the most. Your house is not just an asset. For most people in this situation, it's the largest single store of wealth they've built over a lifetime. It's the thing that was supposed to matter after they were gone. Letting a $25 form determine what happens to it without understanding what that form actually does to the tax basis, to the Medicaid clock, to your kids' exposure. That's the gap this video was trying to close. The step-up in basis isn't complicated once you see it. The 5-year look back isn't a technicality. It's the rule that determines whether that transfer you made actually protects anything. And a Medicaid Asset Protection Trust isn't a tool for wealthy people with complicated estates. It's a structure designed specifically for the situation most people in their late 50s and early 60s are actually in. You don't have to have all the answers today. But if this video moved one thing, if it turned I should probably look into this, into I need to make one phone call, then it did its job. At Wes Investor, we're not here to help you optimize spreadsheets. We're here to make sure the decisions you make about your money in the next 10 years don't quietly cost your family in the 10 years after that. That's the work. If you haven't already, subscribe. The next video covers what actually happens to your 401k when you turn 65, the required withdrawals, the tax bracket math, and the moves that most people wait too long to make. It's the conversation that belongs right next to this one. John's son paid $75,000 he didn't have to pay. You still have time to make sure yours doesn't.